Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your lender of choice as I have access to lowest rates at the lowest cost in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. The bond market has been pointing toward higher rates since last August. Mortgage rates were able to defy that trend at first, but finally began spiking in the new year. February and March were two of the worst back-to-back months in years. The higher the rates went, the more likely it became that we'd see at least some sort of pushback in the other direction. Anticipation and anxiety were running high as rates hit long-term peaks at the end of March. Now, 2 weeks into April, it's clearly the month we've been hoping it would be. Rates haven't dropped this quickly since the pandemic began. The bond market, which dictates rates, has a few quintessential sources of motivation. The economy is at the top of the list. Indeed, a brighter economic outlook due to vaccines, falling case counts, and stimulus was a key ingredient in the recent rate spike. Ironically, strong economic data appeared to have the opposite effect on rates this past week. Last Thursday was the best example of this opposite reaction. Two key reports were released at 8:30 a.m. weekly. The weekly jobless claims dropped significantly, finally making it back to a range that existed before the pandemic. I had to go all the way back to the financial crisis to see anything as high. There was a more clear-cut victory in retail sales report, which surged to 9.8% for the month of March. Economists were expecting 5.9% after a 2.7% decline in February. This was one of the three strongest reports on records, but it also coincided with the third round of COVID relief stimulus checks. The stimulus effect could help to explain why the bond market was able to look past the data. Bonds continued to improve throughout last week, with the 10-year Treasury yields ultimately hitting their lowest levels in more than a month. The notion of discounting data due to stimulus payments is not enough to account for last week's strong performance. Bonds were simply on a mission to improve, and that's generally been the case for the entire month of April. It's not uncommon to see a new month push back in the other direction as after a strong momentum in the previous month. Imbalanced trading positions were also susceptible to getting squeezed. Specifically, a large number of traders with short positions, example betting on rates moving higher, were forced to cover those positions by buying instead of selling as bonds improved. More buying begets more short covering, and pretty soon it becomes a snowball move toward lower yields and rates. There was some additional evidence for the snowballing thesis as yields moved back up last Thursday afternoon. Maybe rates didn't really mean to fall quite that much. By last Friday, most of the improvement was erased, but not enough to derail the friendly trends seen so far in April. It's the market, and one can never be sure. If things go well, seasonal patterns suggest a yield bottom in June, July, and August. That's happened 6 out of the past 10 years. It's impossible to know how much rates could fall, but there's definitely more resistance in that direction. Bigger improvement in rates would be reserved for more dire economic scenarios, the kind I frankly hope not to see, no matter how much I like to see low rates. If things go poorly, rates may not go much lower before beginning a steady grind toward higher highs in the coming months. How high depends on several factors, but in previous videos, I've highlighted a precedent that suggests 2.4% in the 10-year Treasury yields, roughly 0.8% higher than current levels. Mortgage rates tend to move at a similar pace, especially now that the post-pandemic disconnect has been resolved. The Consumer Price Index, CPI, is one of the key inflation reports. The Fed will continue buying bonds and keep short-term rates low until this number and others like it are closer to 2.5% on a sustained basis. This week's release clearly says we're not there yet. Housing starts measure the number of new home construction projects that have reached the groundbreaking phase. This week's report for the month of March was the best since before the financial crisis. With the construction numbers in mind, it's no surprise to see builder confidence remaining near all-time highs. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that's for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.